Hello, everyone, and a very warm welcome to today's major markets update for Friday, October 11th, 2024. In our previous update, we had an introductory slide with a bull because the bulls were in charge as long as pullbacks continued to be shallow and as long as our ending diagonal path continued to play out. And that continued to do so. The bears have been unable to even break price below the first warning levels. And if nothing happens to the downside, we will move to the upside. Markets can move three ways. It's either a trend up, a trend down, or a trend sideways. We've had a sideways trend over the last 10 days. I believe 10 days in a row, it alternated between an up day and a down day. And then, of course, some of the trading doesn't work. One of our ETF trades alerts, especially on the Dow, got like 4 losing trades in a row. But then eventually when the market starts trending, and all of those were just 25% sized positions. So it was really like peanuts. And it happens, but eventually the market starts trending and all those losses will be forgotten. That's why you have to stick with it and your system. Because remember, in the end, price is the final arbiter. Seen many people look at market breadth, look at sentiment, look at the VIX, all those things to somehow forecast where the market will go, but not look at the index. But the index is where you need to look. Market breadth is important, absolutely. VIX is important, sentiment is important, but nothing is more important than the actual index. If you want to forecast the weather, you have to look out through the window and not only at your computer screen, of course, right? That's how it works. So you have to look at the index first and foremost. Then you can look at market breadth. We always call that tier 2. And then you look at sentiment. It is like tier 3. Then you look at seasonality. That's like tier 4. And the VIX, I barely ever follow. And I'll show you all of that in today's webcast on why you have to follow price and why everything else just matters like on the surface. That's really it. I don't know how to else explain it. It's not as important. Price is most important. Everything else is tier 2 at best. So we're going to go straight to the charts, you know, all how this works. And we'll start off with the Dow Jones. Again, the Dow Jones here, as you can see, had been up, down, up, down, up, down here for quite a long time. And as I mentioned before, we had a correction more in time than in price. Corrections can be two ways. It can be in price, right? Or it can be in time, as long as you get rid of overbought conditions. So we put the warning levels on the map and none of it got broken to the downside. My ETF trade alert bought yesterday at the close for UDOW, 3-time Dow, and it's already up almost 3% on the day. That was easy, super easy. I don't understand why people do not want to subscribe to that, because I guess you don't want to make money. Well, whatever floats your boat. It's fine. Just always mind-boggling the decisions people make. Again, it's just it's interesting. I should probably be a psychologist instead. Anyway, so here we are. CSA targets into the 44,000. That's what we're gunning for. We've raised the warning levels accordingly, and today's open and low is the first one. Then yesterday and I've raised the third warning level to this low here at around 41,850, I believe it is. Again, this is a 100% bullish chart. We're well above the 10, 20, 50, 200 day. All of them are rising. Nothing bearish whatsoever. MACD neither. So we'll continue to look higher and we'll continue to ratchet up the warning levels. This is the bigger picture chart. You've seen this before. Again, we are on our way into these ideal target zones, right? Anywhere around 43,500 plus or minus 500. Maybe we can narrow this down. Let's do that. Would be a good idea. That this has been on the chart for ages now. So something like that. So we're getting close, but again, I have zero signs of a low being in place. We'll keep all the warning levels as is. And this can easily go also, if it wants to 46, 47,000. If we see a extension, okay, that is absolutely possible. So we remain bullish. Absolutely. Look at the weekly chart. Where are we in relationship to the moving averages, the 20, the 50, the 200 week moving average, all that stuff. 100% bullish. So we must remain bullish. This is the NDX, bigger picture, Elliott Wave Counts since October, December 2022 with the preferred and alternative wave count, and we might need to switch between the two. As I've explained many times before, it is uncertain at this stage if the December low was the wave 2 or if the December low was indeed actually the final low of the bear market of 2022. So then we should call this alt 0, right? That was a very deep retrace of the ultimate low here in October last year. And very deep retraces can be a failed end to the correction, meaning it doesn't go below the previous low, or indeed a second wave, but second waves don't tend to go this deep. Oh, well. So then we have our alt count, and we'll go in a minute over this. So the preferred count, I guess, it's 50-50 at this stage, is pointing here to 21,500 pullback and then 22,500. So this is possible, okay? This is projected. I'm not saying this will happen, but this is possible. We have not broken below the first warning level, neither below the second, of course. So this is also a 100% bullish wave of count. And if we break pretty much above today's high, which is yesterday's high, and gets us above this green A1 potential, then we can look for that 20,600, 700 and beyond, which is our alternative wave count. Okay, we can still go there, and that's it. It doesn't have to necessarily be. So I would say for this index, it is 50-50 between the two. But for now, we prefer to look higher. Okay, we have zero indication the top is in place. Semiconductors looks bullish to me. If it can break out above this gray A1 of A wave, then I'm looking here for that 5650 plus or minus 150, but possibly as high as 5850 for this CSA gap close here. Nothing bearish here either. We're holding above the Wednesday low, which is equal to the Thursday low, etc. Right? It is really looking good, and that low, of course, is equal to the March high, as you can see. So that was resistance. It was resistance and support. Again, about resistance here, and now we just need to get back above this A wave high, and then we can target that upper end and close that gap. And the alternative is that we are indeed topping out for a B2 already. But we need to see the breakdowns. And for now, we don't see the breakdowns. So we keep the warning levels for the bulls as is. Everything is on a buy. We're above the 10, the 20, the 50. And the 200-day Ichimoku cloud is turning green. So we remain bullish on this one until proven otherwise. That's the alternative wave count. And then last but not least, onto the SP 500. This is our ending diagonal wave count, where we bottomed for this wave B. Disappointingly low, but remember, in bull markets, downside disappoints and upside surprises. And I'm going to adjust this little wave 2 here, there, a little better. I like it. And we should now be in this C wave to ideally 60.57. That's the ideal, okay, with a first stop here at around 58.40, 58.50 for simple symmetry. And look, we're at the upper Bollinger Band above the 10, the 20, etc. So we can also raise, of course, the warning levels for the bulls here accordingly, which is about today's open, which is about yesterday's low. The second warning level would be probably, I would say, somewhere around here. And then the third warning level, I'm going to put it right there. Okay, so I'm going to raise the levels. The ultimate warning level still remains here at 5,400. So the other ones are now raised, and I prefer to look higher. We're at the upper Bollinger Band. They're expanding. It looks like it has strength. And you can see the same here for the Dow Jones. We're at the upper Bollinger Band. It looks like we have strength. And we should be able to move higher. If I look at the semiconductors or the NASDAQ 100, don't have Bollinger Bands on that one. I do have it here. You see here the Bollinger Bands are starting to expand. So that's also strength. Look at the Bollinger Bands here starting to expand, also strength. And the strength remains for as long as we hold above the warning levels. Very simple. So this was the alternative wave count, I would say the final alternative we had for this B wave. And I think we're getting too far. So the only count I've left is now the ending diagonal. I don't really have a bearish option for the S&P 500. We'll get one if we start breaking below the warning level. So yeah, I'm sorry, I don't have an insurance policy for you right now. but we have the warning levels in place. It's getting too high for this B wave. I have a very hard time seeing this as a B wave. Yes, it's possible. We've seen B waves extend more before, but I find it highly unlikely. So we'll just keep it on the map, but less likely because we've broken below all these above all these warning levels for the bears. So then we move on, last but not least, to the IWM. I believe we have bottomed for wave C of B at yesterday's low. It was a marginally lower low. Again, it held above all the warning levels. It held the second one, as you can see. We didn't even close. And today was a strong candle. My ETF trading alert gave a short-term buy signal. That's really nice. Let's hope we get follow through. We're above all the moving averages, the 20, the 50, 200-day above the Ichimoku cloud. And if we do simple projections on the C here, the C wave, which equals A from this B wave low. It's all ABCs, by the way. It looks very ugly. I have a hard time counting this as an impulse. Then I have red A, red B, and then we do red C is A, gets us to 232.5. This one gets us to about 237.5. Then the gray C and the green C, so they're all lower degree C waves, get us to 235 and about 236. So this is our ideal target zone for this B wave, around 235 plus or minus 2.5 for the IWM. Currently, we're at 221, so there's about 10 to $12 upside potential for this one. Can always extend, but for now, I wanted to see if there's some nice confluence of all these C waves, and that appears to be the case. This is well within the margin of error for all of them. So I like it. So this is our target zone, contingent on holding above the warning levels, which are on the chart. I've raised them accordingly, and again, we bottomed yesterday right here at the 50-day, so we're good. On that sense, we prefer to look higher, contingent on holding above, for sure, yesterday's low, because otherwise it is possible to count 5 waves lower. It's not really nice, but there would be some sort of leading diagonal one. We're going to top out here at around 222.5, and then we must break below yesterday's low to trigger this 345 setup for 5. So this is our alternative. This is our insurance policy. If we start breaking below yesterday's low, right, that is already a serious warning. This might unfold. If we then break below the September 6th low and especially the August 5th low, then this path will be the preferred path. So you definitely, if you're long, of course, you don't want to hold it all the way down from 220 down to 160. This is way too big a loss. So that's where you then say, you know what, I've been speculating. Remember from our previous webcast, you are a speculator. I've been speculating on that the path forward is higher, but our speculation was wrong. Our guess was wrong. How educated it might have been, it was wrong. And we reversed the trade because if I stick with the trade, if I stay full-heartedly and I am not flexible and open-minded, I will lose a lot of money. Please swallow your pride, so to say. Please accept that we have then been wrong, but it is already in your policy that this will happen if, right? It is a probabilities path. It's not our preferred path. Why? Because the chart's 100% bullish. There are some issues with this wave count. But okay, this is what it is. So moving on, AD line, very close to making a new all-time high. That's not bearish. Very simple. So this is a very strong indicator to help you determine the direction of the market. If we then look here at the bullish percent index, we might start to see some negative divergences. We're in the topping region, but we've gotten rid of some of the overbought conditions and we can still move higher, similar as we did in early 2024. Okay, so this one still looks constructive, of course. It is bullish, not bearish. If we look here at the McClellan oscillator, we are rapidly turning positive. That's really good. We want positive breadth. You can see the market has gotten rid of all the overbought conditions. And once we turn positive, we can also turn the summation index back up around. It completely got rid of its overbought conditions. And similar to early 2024 and the summer of this year, you can see how price has moved higher while there was a sell signal, okay? And all this does is get rid of overbought conditions to allow for higher prices. So yes, it is maybe a narrow market, but as you can see here, for example, on this decline, we were in a buy signal, but this decline, we're on a sell signal. This rally, we're on a buy signal. So sometimes these signals reverse. It's okay. It shows you, again, that price is the final arbiter, and you should not only rely on this one for your trading cues. If you said here, we're negative market breadth, so we're going to decline. No, No. And the same here again, no, it happens. But here we're correct. Here we're correct. So it can happen, but sometimes it doesn't. So that's why we have to look at price. And as long as we stay above those key levels, we'll move higher. And that happened also here in June, July, and February and January this year. So this one has now plenty of room left for the upside. That's bullish. This is the same, so we don't have to look at that one. Let's look here at the PMO index. Well, that one was still on a sell. It should probably be bottoming out today. That's also quite interesting. Also showing it doesn't work all the time. Similarly, what we had here in February, March, April, very choppy, but still the market moved higher. So it can happen, right? We've had some very nice ideal buy sell triggers, and this one might become a little awkward, but it often again signals that we're in a final wave of a larger rally. Then we're going to look at sentiment. So sentiment is quite bullish in that sense. Almost 50% of all participants in the survey for this week were bullish and only 20% bearish. Well, that must mean that it's a market top, correct? Look how low bearish sentiment is over the last couple of years. So this starts to suggest, oh, okay, we're going to crash. No, not 2023 here at the end. There were even less bears, and look what the market did. 2021, there were even less bears, and look what the market did. Okay, 2019, there were even less bears, and look what the market did. So this doesn't seem to be a very reliable indicator. We're going to zoom out to almost 40 years of data, and we can have a lot fewer bears, as you can see, a lot fewer. So this is really noise. That's all there is to it. So don't look at this. This is noise. We can go to single digit, and still the market will continue to rally. Okay, so actually this means from a low perspective, not. What I prefer to look at is the opposite, very high bearish sentiment. That is often a much better indicator for a bottom. Low bearish sentiment and high bullish sentiment is actually natural stage of stage of the market. Look here, some people look, we're 50% bullish, so we've had much higher levels of bullishness. Look here in 2003 and 4, how bullish people were, and what did we get out of it? Same here. So again, this is noise. Doesn't mean anything. Don't look at this indicator. How about the bull-bear spread then? Okay, the difference. It's also doesn't tell us anything either. So this is nothing. Okay, so you can put this to rest. Doesn't work. Not at the moment. What works is often very extreme high bearish sentiment readings. Those go much more inside with significant bottoms. Extreme high bullish readings, not so much. Or as they say, the market can stay exuberant much longer than you can stay solvent. How we're doing on active management exposure? Yeah, 90% is nothing too crazy. We want to see leverage over 100. That's often closer to a top, and again, not always. So again, this is not the most reliable of indicators. VIX, it's high, it's a 20. Historically, we've been higher. Sometimes the VIX here goes up while the market rallies. Look here from 96 to 1999, how the VIX increased, and the market too. And then from 1998 to 2003, the VIX almost stayed the same, almost declined, whereas the market declined too. Just not much movement. Look here in 2007, 2008, VIX really went higher, and then it went lower in the initial stages of the market crash. And not until we got this very peak readings is when the market bottomed. So again, this is counter argument. Same here in 2022. Look at the lower and lower VIX readings. Okay, so no, I don't find the VIX a very reliable indicator. Yes, sometimes it trends with the market, and sometimes it doesn't. So this is neither the do all, can all. This will explain everything indicator. Price is the only one, because that's the one you trade. You don't trade the VIX. This is why I don't pay too much attention to the VIX, other than if it gets extremely high. Same as with sentiment. If that gets extremely bearish, it's a much better indicator for a market bottom. Tops are not really well telegraphed with these very low readings or increasing. Look how long it took here for finally the market to top out. The VIX went from 12.5 to 30 before it finally started to matter. Same here, the VIX went from 10 all the way into the 30s before it finally started to matter. So we might be in a similar setup, but I don't see anything bearish yet. Price will tell me that. So again, don't look at the VIX to trade the index. Look at the index to trade the index. And then we use everything else on the side to kind of suggest, are we looking the right way or not? And all the other ones currently are telling us, I think we should ignore these signals. We'll still look at them, but for now, for the trading, I prefer to ignore them and just see as interesting developments. But that's about it. If anything, I think market breadth is more important and we have room to improve. So that's all I have for this week. Thank you so much for listening. Take care. Have a great weekend and we'll see you all next week.